Good morning. I'm Lucrezia Reichlin. I'm a professor at the London Business School, and I'm hosting this seminar today. And welcome to the fourth webinar at the Wheeler Institute here at the London Business School on the subject of disclosure, data, and infrastructure related to climate risk. Today, the main speaker is Frédéric Samama, Head of Strategic Development for Standard & Poor Global Sustainable 1. Hello, Frédéric. Thank you very much for being with us today.
My pleasure, Professor.
Very good. And before I introduce you properly, let me also say that today with us we'll have another speaker, Stephanie Van Dijk, who will help me moderating the Q&A session. Stephanie is an LBS MBA student, class 2022. She leads the sustainability pillar in LBS Social Impact Club, was previously an intern for the Wheeler Institute Digital Scale project. And Stephanie has worked across various roles, including at a development finance advisory firm, a leading government tech incubator, and a leading clean energy company, primarily across sub-Saharan Africa. Prior to the MBA, Stephanie worked with a life science multinational to develop their sustainability strategy in East Africa and Latin America. A few words about the Wheeler. The Wheeler Institute was founded with the general support of Tony and Maureen Wheeler, founders of Lonely Planet. It is a research institute here at LBS, which seeks to apply business expertise to social and economic challenges in emerging markets and low-income countries. Besides supporting and driving research at LBS, the Wheeler also hosts public talks and events, and the series of events we are doing on climate is part of the activities of the Wheeler. Few words now on housekeeping. The webinar will last 1 hour in total. We will start with a conversation between Fred and I on his work, and then that will be followed by 20 minutes on QAs that Stephanie will moderate. To the people participating, the Q&A functions is enabled from the start, so feel free to submit your questions as we speak and throughout the webinar, and we will do our best to include your questions, aggregate them so that everybody can have a voice today. So, I will moderate the first part, and then at 14:40, everybody will have a chance to speak. So back to you, Fred. So again, it's a pleasure to have you here. And, Fred, you started your career at JP Morgan and then joined Amundi. There, you pioneered the first mainstream equity low carbon index and launched the largest green bond fund at the time to finance green infrastructures in emerging markets. So you've been a pioneer in this field, and your voice is a very strong voice in the whole discussion among regulators and markets and so on green finance. So you also co-author a very highly influential report that was published by the Bank of International Settlements, the Green Swan. And well, you have written extensively on green finance with a number of co-authors. Some of them are good friends of mine. And you're an asset manager, but you have also had more than a foot in academics work and research. Now, in February, you joined Standard & Poor, so that's very recent, as Head of Strategic Development for Standard & Poor Global Sustainable 1, which is defined as the central source for sustainability intelligence from Standard & Poor Global. So let me start with a personal question. So telling us a little bit about your journey, how you got interested in climate, and also what is this new job you just took? Okay, so what is it that you are trying to achieve? You're aiming at? What's the definition of your job and your ambitions for it?
Thank you, Lucrezia, and I'm very glad to be with you and to share some thoughts on this fascinating topic. To answer the first part of your question, there's something in common all my career long is financial innovation with impacts on society. So I started at JP, as you said. I've developed after that the first employee share purchase programs with a leverage effect. Now about 50% of the French companies are using my technology. It was a way to get employees associated with the performance of their companies. I've developed the first low carbon indexes and so on and so on. All the time, it's about how to combine existing or new financial technologies in order to do something that will have an impact for society, employees, climate change, and so on and so on. So why did I enter the space of climate change in 2009? So more than 10 years ago, and we were not so many at that time. 2009 is just after the peak of the financial crisis, as you know. And as you know, we were that close from a total collapse. And we are all Europeans here, and we know that sometimes financial crises are not only about money, they can end very badly, like in the 30s. And so I felt we have more and more severe financial crises. Governments are not always so good at anticipating or managing. Can we think out of the box? Have we explored everything? And at the very same time, the sovereign wealth funds were highly criticized. Angela Merkel, Nicolas Sarkozy, everyone wanted to suppress the voting rights. Countries were nervous that they could buy parts of the economies and so on. And I thought, maybe we are totally wrong. These players have a lot of money. At that time, $5 trillion and on the road for 20. They don't have liabilities. They have long-term investment horizons, and they are supposed to transfer wealth to the next generations. So actually, if there is one good candidate among everyone to internalize externalities, to anticipate the fact that risks that are mispriced over the short run could eventually get priced over the long run, these people. So they have a competitive advantage at time horizons, and so they could generate additional returns while having a positive impact on society. Not to be too long on that, I was lucky enough to meet with someone you know well, Patrick Bolton, and we partnered on this topic, and then with Joe Stiglitz. And so all together, there was an academic center that partnered with Columbia University, and we had a strategy at 3 levels. The first one was to gather policymakers, academics, investors, practitioners. And in 2009, it was totally new because the topic of climate change was only in the hands of governments and NGOs. The thinking, the idea that investors could be part of the picture was totally new. And so we did that. These gatherings, we try to address some of the fundamental questions that investors can face, what is the value of long-term investing and so on. And third, we developed some concrete solutions. And we thought that by combining the 3 things, the debates, the fundamental questions, and the concrete actions, by combining the 3 layers, then we could have an impact. And one thing brings another one, as you said, developed the first low carbon indexes, launched the first coalition of investors, testified before the US Senate, and so on and so on. So.
Well, what about today? So what are you going to do at Standard & Poor's?
Okay, it was the past and now the future. It's very much related. For 10 years, it was about making the case. Why climate change? What kind of impacts? Is that part of the fiduciary responsibility? And so on and so on. Honestly, the battle is done. As you know, you have more than 100 central banks within the network for greening the financial system. So all central banks are getting mobilized on climate change. Among the investors, you have Climate Action 100, more than 500 investors representing more than $50 trillion, engaging with the top 100 most polluting companies, and so on and so on. So the pressure is no more on the people who are doing something, but on the people who are not doing something on climate change. Okay. The truth is as well that when you ask people, okay, you now are convinced, mobilized, and so on, but what do you do concretely? And I think it's now time to work on very simple, scalable, transparent solutions. And as you know, everyone is benchmarked almost. The passive products are booming everywhere. So by joining a firm that combines the data, the financial analysts, and the index capabilities, it's a way to, I'm joining the factory where maybe we will design the products that will really help investors shift the trillions. Not only talk about it, but really take action. That's why I've joined S&P.
Okay, very good. So now in the previous three webinars, we talked a lot about disclosure with Emmanuel Faber and with Clara Barbie, and we talked about impact investment with Ronnie Cohen. So today we would like to shift a little bit the focus and actually ask your opinion on what are the current trends in this green space and focus finance, of course.
So first, I'm very honored to speak after Emmanuel and Ronnie. They are two incredible leaders. So I feel very humbled to speak after them, and they had a real impact. As you know, Ronnie with his career and then shifting towards impact, and Emmanuel now at the new foundation and so on. They're clear leaders that we should all admire. That said, something quite fascinating happened at the COP26. At the COP26, you had investors taking the commitments, and investors means banks, insurance companies, asset owners, asset managers. They all took the commitment to be carbon neutral by 2050. But here, size matters. They represent $130 trillion. And that's the first time ever that we have such a big picture on the table. It's so big that usually I say, 1 BIP, 0.01% of that is $13 billion. So the fraction is still a very big number. So it says something about the magnitude. And why does it matter? Because we had that tipping point at the COP21, the tipping point of the wake-up call. But then in a certain sense, everyone chose its own path. Governments with NDCs, green bonds, and so on and so on. And then suddenly, 6 months ago, we had exactly the opposite trend. Everyone was converging on the same objective, to be carbon neutral by 2050. And not only investors, but countries, representing more than 70% of the emissions and so on, and with a good balance between developed and developing countries. So suddenly, everyone is saying, we share the same objective, and for unseen numbers so far. And when it happens, when you have this alignment of planets with that magnitude, it's a form of tsunami, and it's becoming the new normal. So that's really the very recent trend that we have observed, and it's a very fascinating one.
Now, we thought, I was also COP26 because I was chairing the steering committee that ended up establishing the Sustainability Standard Board that Emmanuel now chairs. We thought that actually standards and disclosure was a big, big achievement to have it not just as voluntary, but something that eventually will become mandatory and therefore auditable and so on. But actually your work has been on something else, about constructive portfolios and carbon neutral portfolios aligned with the carbon neutral pledge. So can you tell us about this idea? And
and actually it's not A versus B, we need both. You're absolutely right, we need standardized data, validated data, and with a very simple idea that when the SEC was established, employees, planets, and so on were not something that didn't matter at that time. But the world has changed. The standard corporate of 2022 has nothing to do with the corporate of 1930. And so we needed to adapt this new framework on the reality of a corporate. Apple is not Ford in the 30s, as simple as that. And that's what you're incredibly well helping to achieve. That's one thing. And the other thing is that question of, okay, we have this absolute emergency on climate change. And the report released by the IPCC on Monday was the very last ringing bell, if I can say. And so here we have something urgent to deal with. And if we fail, it means that about 4 to 5 billion people at the end of the century are in danger for their lives. There's a paper from Mora and the co-authors in Nature in 2017 that makes the case that it's very clear. If you live in South America, Africa, India, and so on, you cannot survive on the worst case scenario due to a mix of temperature and humidity. So the very first point that we all have to keep in mind is that when we talk about climate change, it's about the lives of billions of people in the south hemisphere of the planet. And so that must be the absolute priority for everyone. Now, the second question is, okay, fine, that's a moral imperative. The regulation is booming. We have to remind ourselves that the ETS has shifted from 4 or 5 euros 5 years ago, so the right to pollute in Europe, towards 95 now. The tax has been multiplied by 25 over a pretty short period of time. The regulation on the auto car makers has totally shifted after the Volkswagen scandal and so on. So there's an ETS market in China. So it's slightly chaotic, it's not coordinated and so on, but regulation is booming and already impacting the earnings. So we have a moral imperative and an economic reality. So now the question is how to do it. And as you are very kind to mention, with Patrick Bolton from Columbia University and Marcin Kakpersik from Imperial College, we have just released, when I say just because it was released last week, in the Financial Analysts Journal, a paper on how to align portfolios with this net zero objective that now everyone has in mind. How do we do it concretely? Because so far there was no concrete solutions. And here we had a very simple and straightforward approach. And if I may use maybe 2 or 3 slides, okay.
Go ahead, yeah.
Thank you. Oops. So here you see the graph.
Yep.
Okay. What does IPCC say? in August last year, they said, in 2020, if we want to achieve the carbon neutrality with a 1.5 degree objective, the carbon neutrality meaning a 1.5 degree increase with an 83% probability, then with the planet in 2020, we have a 300 gigaton of CO2. And in 2021, we have already spent 31.5, and so we only have 268.5. So what is very interesting is that we have a starting point, we have an end point, and we have a volume that we can spend. We cannot count on capture done by oceans and lands because we have achieved already a limit, reached a limit. We have to be able to do some capture on the remaining emissions, but overall, we have this pink part that is a volume. Period. So we have a starting point, we have an end point, and we have the integral, the surface. And it means that if there was a big planner at the world's level, he will say to the human beings, you can spend 31.5 in 2021. You can spend in 2022, 28, 2023, 25, and so on and so on. And the sum will do what is here. And the main idea of the paper is to say that what is true at the world's level, but unfeasible, can be done at the portfolio's level, meaning we can have exactly the same trajectory for any portfolios. And here you have the example of a European index. So the very simple idea is to say, that means that to the portfolio manager or to the index manager, year after year, we allocate a carbon budget that the portfolio manager or the index manager allocates the way he or she wants, depending on the carbon footprints that prevail at the time. And as it will follow exactly the path that should work at the planet's level, we can say that the portfolio is 1.5 degree aligned. It's super simple.
And how do you deal with the commitment the companies have to decarbonize? I mean, do you take the world as given, or so with this kind of forward information?
That's a good question. Here we take exactly what happens, not the forward-looking data, but we could. Okay, I was not supposed to, so I will switch to my appendix now. We could say, instead of having allocating 1 year carbon budget and spread it among what the corporates are emitting, what we could do is allocate a 3-year carbon budget, 21, 22, 23, 24, and then allocate based on what the corporates are supposed to do. So sorry, here you have a very simple example. You have 5 companies, and on year 1, you see that corporate B doesn't look good. Corporate C looks very good. But you can see that corporate B is decreasing, although corporate C is increasing. And so by having this forward-looking data, we could already take that into account in order to reward the corporates that are well-positioned and the other way around. So we can have that kind of forward-looking approach.
So you need those data, right, to do this adjustment. In principle, you know, these data are supposed to be disclosed by companies because they are supposed, you know, at least these are the guidelines we're suggesting, that companies will have to disclose on how they will adapt to transition and physical risk, you know, over time. So in principle, you'll have this information, but you know, the information so far is quite confusing to look at. So that
yes, well, 3 things. The first one is that we can already do it on the current emissions. Then in the paper, we say that corporates should disclose their carbon guidance, like the earnings guidance, and say, okay, your Peugeot or Total, you already know what is in your pipeline in terms of products. So actually, you should already communicate on what will be, your carbon footprint in 1, 2, 3 years from now. That said, and there is a growing literature on that, the recent past is a pretty good predictor of what will happen in the near future. There's a recent paper from AQR, for example, that makes that case and so on. And Martin has been working on that as well. So we could already have, a corporate is not shifting overnight. So we could already have a pretty good idea of what Volkswagen will produce in the next 3 years. So we could do it. It's not perfect, but then there's an important point that I would like to share with you is that graph. That graph says that everything I've said so far is about reducing the volume of CO2, volume, not intensity, volume of CO2 by 10% per year over the next 30 years. That's what works in 2021 to be carbon neutral with 83% probability. The problem is that the carbon budget shrinks, exactly as IPCC said on Monday. And so it means that the minus 10% becomes minus 18% in 2025, tomorrow, and becomes impossible at the end of the decade. And so there's here a very, very strong message is that there's a cost of time that is incredibly high. And so, yes, we can wait for very, very good data. But honestly, I've heard that for the past 10 years. When I started in 2011 to work on the first low carbon indexes, people were already saying, Scope 3 is not perfect and so on and so on. But now we don't have that luxury anymore to wait for 3, 5, or 10 years. Because by definition, if we have perfect data at the end of the decade, it will be almost useless because we will have spent the budget. So we need to do things in parallel. We need to take action. And by taking action, it will as well accelerate the price discovery. Because the more we launch these products, the more it challenges the corporates. And so you have a kind of positive cycle here. So
yeah, no, I agree with you. We cannot wait forever, but the data issue is very important because in your portfolio construction, you have to rank companies, right?
Yep.
That's on the basis of their emission. And especially Scope 3 data are very difficult to obtain. But also, what companies disclose, without standards is difficult to evaluate as well. So there is a data problem, there is a standard problem. This is not the same thing, right? So
you're absolutely right. You're absolutely right. And at the same time, as we say in France, at the same time, it's very popular, we have providers. It's not about promoting one versus the other one.
No, okay, we'll go back to the providers because that's quite a messy landscape, the landscape of data providers, right? I would like you to talk about that.
But to make a long story short, at my previous job, I was using one of the data providers that now I know very, very well, not to say a name. And we have decarbonized portfolios since 2011, and we have adjusted and so on. We have an estimate on the Scope 3 downstream. For the auto car makers, we take into account their production plans and so on. So at the end of the day, we have a good idea of Total versus Exxon and so on. And so it's feasible. And the last thing I would like to say on this is this graph. Because very often we talk about precision and so on. But we have to keep in mind that we only have the 300 gigaton of CO2 that we saw is disappearing very, very quickly. But it's not only the bad part of the news. The other bad news is that the level of uncertainty around that figure is almost equivalent to the figure itself, meaning that the IPCC says, oh, about the graph comes from the IPCC and the comments as well. The permafrost, we don't know 100 gigaton of CO2. The link between non-CO2 and CO2 in order to make something homogeneous is plus or minus 250 gigaton of CO2. The link between the CO2 and the temperatures, it's another 250 gigaton of CO2 in certitude. So what I'm trying to say here is that we are in a very bad situation where we are already very close from the lower bound, 300 versus 0. And knowing that over the past 20 years, we have spent about 1,000. So we must spend, we must reduce dramatically. The budget is very, very small. And the level of uncertainty around the same budget is more important. You make the sum, you achieve 600, it's twice the size of the budget itself. And so, yeah, we have a lack of precision, but the big picture is so to be wrong by 20 or 30%.
Yeah, another question is that in this ranking, I imagine that, companies, of course, the companies in certain sectors like energy or auto and so on are penalized for obvious reasons, right? So that...
No.
No?
No.
Okay, good. Explain it.
No, because, do I have a graph on that? Poof, poof. Okay, I was not supposed to. I promised that I will share only 2 graphs, so I'm not keeping my word. I'm sorry. I apologize to everyone. Here you have a graph that shows a tracking error. So it means that how these indexes are deviating from the benchmarks. And to build these portfolios, we have added sector constraints.
Okay.
It means that if the oil industry represents 6%, I don't know the figure, it's just to take an example, we cannot deviate from this 6% more than 2%, meaning to reduce to 2%. Okay,
so you have it by sector. What about countries? What about penalizing excessively emerging markets?
That's another good question. But then what most of the investors are doing is actually they invest one pocket with the other one. Meaning that, and you see the figure, that's why I have 3 graphs actually. The blue line is Europe, and the red line is emerging markets. And so, because it's that most of the time, the way that investors are doing, they don't mix Brazil with Italy, to make a long story short. That said, if an investor was to say, no, I want a world index, we could have exactly what you said, that what we've done at the sectors level, we can do it as well at the countries level in order to avoid that point. And why does it matter? It matters because we don't want to ban corporates. We need the engineers at Peugeot or Total or Exxon and so on. They have bright brains to invent the future. And so by banning the sectors, we will not mobilize them. And so one of the beauties of the strategy we present in the paper is that we can have the exit roadmap of the corporates in our portfolios with a sector neutrality, meaning that we can say, because as we know exactly what will be the carbon budget in 1, 3, 5, 10 years from now. So we can say, let's imagine that we are in 2032. In 32, we know the budget. We take the emissions, either constant or forward-looking, and we do exactly the same exercise. And we do that before and after. And then we can observe if a corporate is or not in the portfolio. And then we can have exactly what you have in front of your eyes. Maybe it's too small, but it's the exit roadmap of corporates. So here we considered only scope 1 and 2 upstream, but we can say based on that, as a concrete example, Enel is to exit in 2028. And then we can share that information with the corporates, meaning that if Enel exits, it means that the other corporates are in the same sector are over allocated. Again, so we are helping the corporates on the right track and penalizing the ones that are not on the right track. But interestingly, and almost fascinating, is that now we have this exit roadmap and we can share it with the corporates. So if you're the CEO of Enel and you have that information, you can say to all your employees, hey, if we don't accelerate or shift towards net zero economy, you know what? We won't be in the portfolios anymore. And what is very interesting is that if Enel does that, well, the others will do the same thing. And so we are creating a form of competition within each sector towards being net zero. And that's
I think it's a very important, I think it's a very important idea. I mean, this dynamic element of your portfolio construction. We have few minutes before I give space to the floor, but there is one question which is quite dear to my heart. You know, data it's very important because we have to build these ideas on data, but also it's a big business, right? And you as you said, you joined Standard & Poor's because they are also, among other things, also data providers, and so is Moody and so on. So don't you think that data should be actually a public good? So don't you think that we should have like a repository in which companies who actually use this data and produce this data put them, for the generalized use, so that make it, that would be a way to make it more transparent and usable also for independent evaluation?
I have two ways to answer your question. The first one is to play the fifth, and the second is to answer as the co-author of the paper. And as a co-author of the paper, yes, it should be a public good available for everyone, absolutely.
Okay, very, very good to hear. So I think I've reached my limit. So Stephanie, now is your turn. So collecting the questions. I see there are a few coming from the Q&As.
Yes, thank you. And thank you both. This was such an insightful conversation. We have a bunch of questions coming in, but just as a reminder, feel free to submit yours in the Q&A function. But maybe I can kick off with a few that have come through. So one, Frédéric, question for you is, what would you like to see from the public sector in terms of government, development, finance, institutions and actors? How can they support this as well? Because we focused a lot on the investors and corporates.
That's a very, very good question. In one of the conclusions of the paper, we and very much aligned with everything I've said in terms of it's now time for action and no more time for advocacy and so on. And there is a lack of concrete solutions. With my co-authors, we strongly believe that there's a utility function of the public asset owners to seed prototypes that will unlock investment capabilities from the other investors. And I will give you a concrete example. With IFC, I've developed a fund that aims at financing green infrastructures in emerging markets. We know that there's a gap between pools of assets in developed countries facing low yield environments and needs of green infrastructures financings in emerging markets that are unfunded, and so it reduces the growth. And we know that it's a lose-lose situation for both parties. And IFC was very smart at thinking okay, I could do it on my balance sheet, with my balance sheet, but the size is not big enough. So maybe with the IFC, we could think about a prototype of a new fund that going to market will be subscribed by investors, and by subscribing to the fund, they will do actually the job that me, the IFC, I would have done otherwise. And concretely, by combining a risk-sharing mechanism and the use of green bonds, we have been able to transfer $2 billion from pension funds, mainly in Europe, towards the green infrastructures in emerging markets. One deal, $2 billion. And that business model has been replicated since then by the European Investment Bank and by AIIB, the Asian infrastructure bank. And there's a paper co-written with Patrick and Xavier Muscat, the former head of the French Treasury and the former chief of staff of President Sarkozy, that explain that, and a case study by Imperial College for people being interested. So the use of public money to bring to the market concrete solutions that will help unlock the investment capabilities.
Yeah, thank you for that. I think to maybe follow on that trajectory, could you give your perspective on some of the regulatory changes? Like, how is the regulatory environment changing? There's some conversation about carbon tax changes. What's your perspective? Is that going to be helpful for investors, or will that potentially provide roadblocks?
There are two waves of regulations. The first one is, well, three ways, I would say. The first one is the one that we have been debated with Lucrezia, the fact that corporates have more and more to disclose. And we also, the recent announcements from the SEC about the carbon footprints, including Scope 3, when it's material and so on. So all that goes into the right direction. EU is leading on that, and it should be public and good and so on. Clear, okay. Then there's a second wave of regulation where the policymakers tend to channel money based on their objectives. And that's the philosophy of the EU taxonomy. It's no more based on risks. And not being based on risks, some countries are not very comfortable with that and so on. And third, yes, you have more and more taxes. And before we mentioned the ETS in Europe shifting from 5 to 95. And I think and there are already products that are trying to assess the impacts on earnings of these taxes. There are indexes being launched on that, because here you're fully aligned with the fiduciary responsibility of managing your risks. So if your volume of CO2 is to boom, and if the taxes associated with this CO2 is booming as well, it's 100% of your part of your fiduciary responsibility to reduce your carbon footprint. So that's a very promising trend. And honestly, it should be the one. At the end, the one that must be penalized are the polluting companies.
Thank you. To go back on data, so can you give some thoughts, actually both of you, how is data provided by companies being verified? Do we think that the verification process is either too cumbersome or actually maybe needs to be a bit more intensive? And who's in charge of that, and maybe who needs to be involved in that process?
Lucrezia? Me, I'm conflicted, so I can't answer. I plead the fifth again.
Well, I think it's very confusing, actually, and trying to understand this because, you know, companies are actually, you know, giving data to companies like CDP or other data providers. Then the companies aggregate this data and then they sell them to investors. So I think we should find a way so that companies can, companies that actually are now, you know, not have to disclose, they would make those data that they use available and then cut the middleman. So, and then the data company would then have another function, which is more the analysis and so on, and rather than just selling the data and just analyze them. But I think it is important that researchers and regulators will have access to the data that that company use, and then data translated in standards, and then the standard setter should be able to verify the accuracy of those standards. And for that we should have rules and standards which are comparable, so that the auditing firms, like they do for financial account, they would have the same role for this kind of disclosure. But the data, what is used for disclosure, I mean, I think we are very far from having a clear view of the quality of the comparability and so on. So I guess that this is going to be the the next step for regulators to look at more. I don't know what you think, Fred.
I fully agree. I fully agree with everything you said. There are two layers. There's what we can name the raw data. So for example, okay, what are your emissions? And that should be available publicly. And then there's a question, as Lucrezia said as well, what do we think about the commitments of Peugeot, Renault, or Volkswagen for the next 10 years? And here that's an opinion. And an opinion cannot be audited. There's an analyst who analyzes, the strategy, the seriousness, the part of effort, everything. But like, a rating agency is not saying here are the level of debt and so on. They say at the end, is the company sustainable or not in terms of solidity. So I think that more and more we will have a split between the two layers. Up to now, the data providers have been collecting the data and providing the opinions. And certainly the collect of data will come from due to the pressure of the policymakers, and the data providers will focus more on the opinions or forward-looking data as well. Okay, what do you think about the carbon footprint of the auto car makers in the 3-5 years from now? And cannot be audited. It's part of your understanding of what is the strategy of the firm and so on. So very complementary.
Great. Another question from a participant who's interested in the differentiation usage of carbon neutral versus net zero as a destination for 2050. How do you see this difference? And that's the first part of the question. And then the second part is, do you believe that a financial institution can be net zero and drive real societal change without simply divesting to lower their finance emissions profiles?
Well, first, net zero and carbon neutrality is the same thing. That's this graph. When we say net zero, it means that you end close to zero and you have a way to capture the remaining emissions. But as we think in terms of asset class per asset class, to simplify the problem, we said, okay, it's close to zero. So that's the same thing. Carbon neutrality, 1.5 degree, net zero, 3 terms that are purely the same ones. You can fine tune by saying what is the probability to achieve that? Is that 50%, 66, or 83? And depending on this level of probability, the carbon budget differs. So here it's, sorry, I've used much more than my graph than I said I would. Poof, poof, poof. So here you see that the last column is if you want to achieve net zero carbon neutrality with 83% probability with the planet in 2020, we have 300 gigatons of CO2. But if you're less ambitious and you say, no, I just want 50% of probability, then the carbon budget increases to 500. So we tend to forget that level of probability that changes pretty much the figures. And then if you're even less ambitious, 2 degrees, with 50%, column in the middle, you see it's 1,350, more than 4 times. So when we talk about confusion, here you have a lot of confusion between which objective and which probability. And okay. Now, the second question is, can we do it without penalizing the polluting companies? But it's exactly the conversation we had with Lucrezia. We have this carbon neutrality. At the end, we keep the oil companies, we keep the auto car makers. But within each sector, we try to identify which ones are greener than the others. And, you know, if you compare Volkswagen and Toyota, you know that Toyota is greener than Volkswagen. I don't know in detail, but we see it. So it's not, and I think the auto car makers are a good example, because we could say, oh, they have been around for more than 100 years, but Tesla, they're all national champions. Human beings should all have the same behaviors in Germany or Japan. So everyone should have exactly the same path. And you know what? No, they have exactly opposite. 5 years ago, they had opposite strategies. Volkswagen was focusing on regular cars, and Toyota was focusing on EVs. And so what we try to capture is exactly that, the ones that are on the right path, while keeping the auto car makers or the oil industry. And the figures are showing that it's feasible.
Yeah, I'm going to combine two questions here. So on one hand, COVID has demonstrated that governments and corporates can really respond to a global emergency with urgency. And in some ways, we could actually fast track this race to net zero, right? But then on the other hand, of course, we have the Ukraine crisis and these geopolitical concerns, which are affecting value chains globally, right? So what's kind of your perspective on those two big geopolitical global factors and how that's going to affect the race to net zero?
That's a very, very good question. We released the Green Swan with Luis Pereira da Silva, Morgan Després, Romain Schwarzman, and Patrick Bolton, and myself in January 2020. We had no idea about the Green Swan, about the COVID, sorry. But we said climate change is a Green Swan because it's a risk that is certain, that conveys a lot of non-linear forces, leading that you cannot establish a model, and threatens human lives. And we say when it happens, it's about action. Not predict and act, but action. And the book has been successful, as Lucrezia said, it has been downloaded more than 140,000 times. It's free, no royalties, you can have it. And the COVID is exactly a Green Swan. It was certain, we don't know, a lot of non-linear forces and threatens human lives. And yes, governments changed their playbooks and said, we will protect human lives versus growth. And so what is true, as you said, for the COVID could be true as well, as you say, fast track on climate change. Now we are facing two crises, like the one in the 30s, a war, and the one in the 70s, the energy shock. And then we have a very simple situation. Either we say we will solve the crisis one after the other one, that's the normal path. And then, like in 45, we sit down and we created the IMF after the war. So we try to reinvent the world after the crisis. That's the most usual way of doing. The problem here is that we don't have that time. If we wait 3-5 years that we solve the Ukrainian crisis and so on and so on, the carbon budget will be gone. And so the policymakers are facing an incredible challenge, is that they have 3 crises, not only 2, but to manage at the same time. That's why we need heads of states that are very serious. For anyone who is
not just about investors, it's also about policymakers. You know, without the policymakers, it would be very hard to do anything. Yeah.
And for every French who is listening to, there are French elections on Sunday. So.
A little plug there. Thank you for that. I think we have time for maybe 2 more questions. So one, I'd love to know what makes you optimistic, especially in terms of innovation that you've seen coming through, whether that's helping investors or corporates? And then I'll end with one after that.
What makes me optimistic is first, because we cannot be pessimistic. It's like it's a war. You don't go to a war while saying, oh, I will maybe lose. There was an Italian philosopher who said a long time ago, Mr. Gramsci, you have to balance your life between the pessimism of smartness and the optimism of will. So maybe the situation is not good, but that's not only the point. You have to fight as hard as you can because there's a war.
Il pessimismo della ragione e l'ottimismo della volontà.
That's better. That's better in the. Sorry, I was translating something in French and then in English. So you did perfectly well, Lucrezia. So thank you. That's a nice sentence. And more seriously, climate change has been on the table since the 70s. We know that. And for the physical stuff since the 19th century. And absolutely nothing was happening. When the French government decided to take the COP21, only 5 people at Élysée Palace were in. And everyone was saying, you know what? All governments have always felt there is no hope that one way or the one we have an agreement. And it took place in 2015, 7 years ago. At that time, there was no hope that central banks would jump in, 100. There was no hope that investors representing $130 trillion would pay attention to climate change. And what I'm trying to say here is that at that time, 6-7 years ago, the price of renewable energy was very high. Now it's dropping. 6-7 years ago, we were all thinking that China will block the process. Now China is leading. 5-6 years ago, there was no tax on in Europe, and the ETS was 4 or 5 euros. And what I'm trying to say here, 4 or 5 years ago, we still had deniers on climate change. And one will be very soon elected at the White House. And what I'm trying to say here is that all these forces that were not very cool are now all aligned in a green way. And when you have this alignment of planets, then the forces are reinforcing themselves. And then you can have hope. Because one thing will bring another one and so on and so on. The question is it to be fast enough versus this time constraint? That's the real debate.
Stephanie, I think we should close now, but it's a good line to close. I know.
We have more questions, but I think that's a good point. So back over to you, Professor. Thank you.
Well, okay. So, first of all, thank you very much, Fred. Also, because not only because of the content of what you said, but also the passion, which is important. And thanks, Stephanie, to you as well. To everybody, a recording of this webinar will be available soon via the webpage of the Wheeler. And don't forget about next week. So we will have a new guest, Richard Cantor, who is the Chief Risk Officer for Moody's Corporation and the Chief Credit Officer for Moody's Investor Service. And the title of his talk will be Incorporating Climate Risk and Opportunities, Insights from a Leading Credit Agency. So have a good afternoon or good morning, everybody, and see you next week. Thank you.